Welcome to Chapter 3 of Intermediate Accounting, Volume 1. We're talking about the KiesoVolume Intermediate Accounting text. And so Chapter 3 refers to the accounting information system and its measurement issues. Chapter 3 is intended to present a concise yet thorough review of the accounting process. Other objectives are to identify and explain the basic procedures of the accounting process and describe the way these procedures are combined in completing the accounting cycle. Without doubt, this is the most procedural bookkeeping chapter in the text. Its importance, however, cannot be underestimated. A strong command of the material in this chapter is essential to knowing the language and the process of accounting, which is used extensively in the remainder of the book and in Advanced Financial Accounting Techniques. So we're going to use it in the second intermediate accounting course and in the Advanced Financial Accounting course. It may come up in the more advanced management accounting courses as well, but in particular, the financial accounting and the audit course depend heavily on your understanding of proper accounting techniques. So it's kind of important. The learning objectives from this chapter include you need to understand basic accounting terminology and explain the double entry rules. You need to explain how transactions affect the accounting equation and identify the steps in the accounting cycle. And there's a list of them that we'll give you in a minute. Identify the steps in the recording process. We'll explain the reasons for particular adjusting entries and talk about how to prepare them. We'll talk about the type of ownership structure and explain how the type of ownership structure affects the financial statements. Then we'll prepare closing entries, consider other matters relating to the closing process. Then we'll talk a little bit about valuation techniques to measure financial statement elements. We'll talk about IFRS 13, which shows us how to measure fair value. And then we'll identify differences in accounting between small business GAAP and public company GAAP, ASPE and IFRS. And we'll talk about what changes are expected in the near future. Not a lot in this area. It's rather an old area dating back from the pharaohs in Egypt and the Italian monks, including a fellow named Pacioli, who gave his name to the professional accounting club here in the city, the Pacioli Club. There are also a couple of appendices to the textbook, which we won't get into in a whole lot of detail, but one includes a 10-column worksheet and set of financial statement preparation techniques. So you use this 10-column worksheet to work through the adjusting entries and closing entries that we talk about, come up with a post-closing trial balance, and then close the books and get ready for next year. There's also an appendix talking a little bit about present value concepts, a little bit of a review of what you learned in 370. If you have taken 370 already, and you probably have, but if not, then that will be coming up shortly. And so if you haven't taken 370, it's probably not a bad idea to read through the chapter. The idea of present value concepts is to try to determine what the value of the interest earned or interest paid on an obligation, a long-term financial obligation would represent. So you need to understand those a little bit. We may have to talk about those in class because I think there's a number of students in this course. If you're taking it in your second semester, you wouldn't have taken 370 because it's usually scheduled in the fall semester in your second year. So we may have to discuss that in some depth in our class time, but we'll see how that goes. Now, this is a summary of what the chapter covers, and so probably not a bad time to start kind of identify and sketch out the plan for the chapter. The chapter covers the accounting process, and so we could describe the accounting process as a set of procedures used in identifying, recording, classifying, and interpreting information. And that information is related to transactions and other events in a business enterprise. So to understand the accounting process, it's important for an individual to be aware of the basic terminology employed in the process, and the basic terminology includes events, transactions, permanent or real accounts, temporary or nominal accounts, ledgers, journals, posting, trial balance, adjusting entries, financial statements, closing entries, reversing entries. All of those terms refer to the various activities that make up the accounting cycle. And so as we review the steps in the accounting cycle, we'll define the individual terms as they come up. You'll remember from your introductory course, we talked about double entry bookkeeping, double entry procedures involving debits and credits. And so we'll be dealing with those in a bit as well, and talking about how we identify whether a debit increases an account or decreases an account. Essentially, once a transaction or other event has been identified as satisfying the criteria for recognition and measurement, which we talked about last chapter, it must be recorded in the accounts, which is step 2. And so double entry accounting refers to the process used in recording those transactions. The terms debit and credit are used in the accounting process to indicate the effect that a transaction has on account balances. So the debit side of any account is the left side, the right side is the credit side. Assets and expenses are increased by debits and decreased by credits. Liabilities, equity, revenues are decreased by debits and increased by credits. This should be fairly familiar to you from your introductory financial accounting course. In a double entry bookkeeping system, for every debit there must be a credit. So each individual journal entry must balance. So for every entry that has a debit, there must be a credit. For every entry where there's a credit, you must have a corresponding debit, at least one. So that leads us to the accounting equation, which you'll be familiar with. Assets is equal to liabilities plus shareholders' equity. And that's kind of where we're going. As we sketch out the outline here, we first of all begin talking about the basic terminology, the double entry rules of bookkeeping. We talk about the accounting equation, which we just did. Then we talk about the accounting cycle and the steps, the particular steps involved in recording transactions and events of the business. We'll talk about journals, posting to ledgers. We'll talk about taking a trial balance, then making adjusting entries. Then we'll determine an adjusted trial balance and use that to produce the financial statements. And it depends a little bit on what ownership structure is involved. Partnerships and proprietorships are different from the corporate form of ownership structure, and so they have different accounts and slightly different look in terms of how we set up the account structure and then use them to determine the financial statement disclosures. And then we talk about the closing process, how we close all the temporary accounts into the permanent or real accounts, and then begin again fresh the next period. Some issues we deal with for financial statement elements: valuation techniques. Some valuation techniques are based on historical costs. Some are based on fair value or measurement of future benefits. Value in use measurements refers to the fact that for most of our business assets, we're planning to use them up in the process of producing our goods or services, and so the value that we pay for things like net fixed assets is going to benefit us over a number of periods. So we measure the value not in terms of what the market value would pay for that asset, but rather how much of the cost is allocated to this period using some kind of reasonable depreciation measure. And we'll talk about that later in the course. We'll talk a little bit about IFRS 13, and it tells us a little bit about how to measure fair value in a way that's consistent with the accounting standards. We'll talk briefly about an IFRS ASPE comparison. There's not a huge amount of difference, essentially terminology. For example, the balance sheet is called a balance sheet for ASPE, but it's called a statement of financial position for IFRS. So those sorts of things represent some differences, and not a lot of research being done in this area. It's a fairly historically ancient technique that we use. So if you want to think about working through a worksheet, which could help you in doing your labs and in doing the in-class problems and such, you can take a look at the worksheet in Appendix 3A and Appendix 3B. If you don't have a good background in corporate finance, if you haven't taken 370 already, you might want to take a look there, and you should practice using your Texas Instruments BA2 Plus financial calculator, which I hope you have purchased. And that is an outline of essentially where today's PowerPoint presentation is going. All right, so a couple of the first terms that we use: events, transactions, and accounts. Events are things that happen, so they're the cause of changes in some of the financial statement elements. And a transaction is an exchange between the accounting entity and some other entity or party, external or arm's length to the accounting entity. An account is where we keep track of subsidiaries of the accounting financial statement elements that we talked about last chapter. So the first step in the accounting cycle is analysis of transactions and selected other events. The purpose of this analysis is to determine which events should be recorded, and if recorded, at what amount, or the measurement issue. To be included or recognized in the accounting process, a transaction or other economic event must affect an element of the financial statements and must be reasonably, reliably measurable. Events can be classified as either external or internal. External events are those between the entity and its environment, whereas internal events relate to the accounting for activities totally within the entity. A transaction can have both internal and external elements. In recent years, the accounting profession has been looking at ways of reporting events that were previously not reported because they were considered too complex or immeasurable. So there may be some new events that we would consider recording within the accounting records. Continue on with basic terminology. The equity section of the statement of financial position reports the owner's interest in the assets of the company. And so a corporation uses accounts like share capital, contributed surplus, dividends, retained earnings, and a sole proprietorship or a partnership would use a capital account and a drawings account. So the capital account is essentially the sum of both contributed capital and earned capital in a partnership or proprietorship, because it's not a distinct personal entity from the owner of the firm. The distinction is not made in the same way that it is with the corporation. The corporation has share capital and contributed surplus, are transactions affecting the original contributed capital in a number of ways. So there's a few different accounts that affect contributed surplus, such as issuing shares at par value or buying back shares at a gain or loss. Drawings are similar to dividends. Drawings would represent money that's taken out of the partnership or proprietorship for the benefit of the owner of the company. So in a corporation, dividends, revenues, and expenses are all transferred to retained earnings at the end of the period. So a change in any of those three accounts affects the equity amount. Permanent accounts include the balance sheet accounts, essentially, asset, liability, equity accounts, and they're not closed at the end of the year because there's a remaining balance that will carry forward to the next period. Temporary accounts are revenue, expense, dividend accounts, and those accounts are held open during the fiscal year, and then at the end of the year they're transferred to retained earnings, and the temporary accounts are closed to start again at the zero balance beginning in the next period. Journalizing and posting. Journals are often called a book of original entry, and the transactions are initially recorded in a journal of some sort. So it may be on a computer, or it may be actually in a physical book of entry, depending on how old school you are. But the transactions are initially recorded in the journal, and so that's the book of original entry. A general journal is a chronological listing of transactions expressed in terms of debits and credits to particular accounts, and the accounts are held in the ledger, which we'll talk about in a second. There's no distinction in the general journal concerning the type of transaction involved. In addition to a general journal, we often have specialized journals, and those specialized journals account for transactions which are repeated with very similar characteristics. So they're used to accumulate transactions possessing common characteristics. The special journals would benefit the accounting process by making it easier by summarizing similar transactions. Commonly sales on account, you have a sales journal that would record all of the sales on account, and so you would have one column that would represent the amount of the sale, and it would be referenced to the particular accounts receivable, and it would be cross-referenced with the accounts receivable subledger, which we'll talk about in a moment. Cash receipts are often recorded in a subledger or in a journal as well, because the cash receipts are common transactions. You generally have receipts for every chronological day, business day that you're open, and so rather than recording everything as a self-balanced journal entry, you record all of the journal entries for the cash receipts, all of them having the common entry of debit to cash. There are other journals, purchases journals. If you're buying inventory, the purchase of that inventory could be recorded in a purchases journal. So there are a number of specialized journals that are used to minimize the amount of work that the repetitive work that goes into recording commonly repeated transactions. We're not going to be talking a lot about specialized journals in this textbook. We talk a little bit about those when we get to the audit course very much later on in your career. So we need to get past a couple of other accounting courses before we get there. We'll need to talk about the second intermediate accounting course and the advanced financial accounting course, because the audit course assumes the knowledge of accounting standards. And so we often talk about using specialized journals at that point. Now, posting. Posting is when you transfer the information from the journal to the ledger. So what is a ledger? I'm glad you asked. A ledger is where you post the transactions that you've recorded in the general journal. So the next step in the accounting cycle involves transferring amounts that were entered in the journal into the general ledger. And the general ledger is a book or computer file that contains a separate page for each account, or a separate page in the physical book, a separate data item for the computer file. So it usually contains a separate page for each account, and transferring amounts from a journal to the ledger is a process called posting. And posting is moving the transactions from the journal to the individual accounts in the general ledger. So transactions recorded in a general journal must be posted individually. Entries made in the special journals we talked about, sales journal, cash receipts journal, purchases journal, cash disbursements journals, are generally posted by summarizing the totals in the columns in those journals, and then we just post the column to what we call the control account in the ledger. So rather than posting each individual transaction line, we would post them as a summary total. The general ledger contains information related to the balance of the accounts included. So many of the accounts listed in the general ledger are supported by subsidiary ledgers in the same way that specialized journals are used for repeated transactions. So subsidiary ledgers are basically where we have one major account which is going to show up on the financial statements. A common example would be accounts receivable. And that account receivable balance in the general journal would incorporate all of the customers and all of their transactions. So it would be very difficult to keep it all in one ledger page. So we would set up a subsidiary ledger with an individual page for each different account. So you may actually have several accounts for a particular customer, depending on how you want to organize the subledger. So each of their debts that they owe to us would be on one page, and it would be related to perhaps different kinds of products that we issue or different kinds of services that we deliver as well. Accounts receivable subledger would contain a detailed listing of all of the individual customer account balances, and so it expands on the one general ledger account. So we'll have one general ledger account, accounts receivable, and that will be reconciled on a regular basis with the total of all of the sub-accounts in the subsidiary ledger. So that's an extra accounting process that's required in order to make sure that the control account in the general ledger matches the total of the subsidiary ledgers. And the idea there is that the subsidiary ledger frees the general ledger from all of the details concerning numerous individual balances. The trial balance. The next step in the accounting cycle is the preparation of a trial balance. A trial balance is a list of all open accounts in the general ledger and their balances. So an entity may prepare a trial balance at any time in the accounting cycle. A trial balance prepared after posting has been completed serves to check the mechanical accuracy of the journalizing and posting processes. and it provides a listing of accounts to be considered in making adjustments and preparing the financial statements. While total debits may equal total credits, errors may still exist. So even if your trial balance does balance, that doesn't mean you have solved all the problems. There could still be additional problems, such as entries might have been posted to the wrong account, or you might have completely omitted an entry, in which case the debits and credits would balance, but they would just be missing from the record in the general ledger. If you journalized incorrect amounts, that would cause problems as well. So it doesn't mean that you're done when you get a trial balance to balance. That's kind of one step. So it just shows that the mathematical balance has happened, right? So the general ledger is in balance. You don't have to worry about that particular issue. But there are going to be a number of other adjusting entries and closing entries before we can actually finish the adjusted trial balance. So the adjusted trial balance is the balance that we take after the adjusting entries have been made and posted to the general ledger. And so the adjusted trial balance checks to see that everything has been properly balanced after making those adjusting entries. And then we commonly do a post-closing trial balance after posting the closing entries, so we can make sure that none of the temporary accounts still have balances and that everything has been closed properly to retained earnings. So those are a couple of steps that we commonly take in completing our work. So let's talk about adjusting entries. Adjusting entries include the things that we talked about in our introductory financial accounting course. So preparation of adjusting journal entries is the next step in the accounting cycle. Adjusting entries are entries that are made at the end of the accounting period to bring all the accounts up to date on an accrual accounting basis, so that we can prepare financial statements. So adjusting entries are necessary to achieve appropriate matching of revenues and expenses. So that's the way we actually achieve the matching. And so we want to make sure that the revenues and expenses are matched in determining net income for the period. And so we can achieve an accurate statement of assets and equities at the end of the period. So all of these things need to be adjusted properly to get to that objective. One common characteristic of adjusting entries is that they affect at least one permanent account or a real account, so assets, liabilities, a balance sheet account, if you will, and one nominal or temporary account such as revenue or expense. Adjusting entries are usually made for items classified as prepaid expenses, unearned revenues, accrued expenses, accrued revenues, and other estimated items. We have some listed here: bad debts, holding gains and losses through other comprehensive income. Those are a couple that deal with some issues that we haven't dealt with in the previous course. We did talk about bad debts, and we did talk a little bit about depreciation, but we didn't talk about the holding gains and losses. We'll talk about those as they come up in the future chapters. Prepaid expenses and unearned revenues refer to situations where cash has been paid or received, but the corresponding expense or revenue will not be recognized until a future period. So accrued revenues are assets, accrued expenses, liabilities, and those refer to revenues and expenses that are recognized in the current period with the corresponding payment or receipt of cash to occur in a future period. Estimated items include items such as bad debts and depreciation, whose amounts are a function of future events and future developments, and so we usually include a substantial amount of judgment in deriving those estimates. As it says, they are estimated items. Then, as we briefly mentioned before, after the adjusting entries are recorded and posted, we would produce an adjusted trial balance, and that adjusted trial balance would serve as the basis for the preparation of these financial statements that are listed here, and we'll be discussing them in more detail in the next couple of chapters. Preparation of the adjusted trial balance and financial statements represents steps 6 and 7 in the accounting cycle, if you're keeping track. So when inventory records are maintained on other than a perpetual basis, we might need to make an adjusting entry for inventory. An adjustment is usually needed to reflect the difference between the beginning and ending inventory. So if we're dealing with a periodic inventory system, we would count the inventory at the beginning and count it at the end, and we would keep all of the purchases through the year in a separate account, and we might adjust it for purchase discounts, allowances, and returns, those sorts of things. And we would only account for the cost of goods sold at a closing period, as closing point. So if we're issuing quarterly financial statements, we might do it at that point, but we certainly would be required to do it at the end of the year. So we would make an adjusting or closing entry, which would eliminate all the temporary accounts, including purchases, purchase returns and allowances, return purchases, purchase discounts if there are any. They would all be closed out to zero, and we'd start again next year. And then we would transfer all of those to cost of goods sold, and we would adjust the inventory from its opening balance. So we'd basically credit the opening balance to get rid of it, and we would debit the closing balance, which we just went and counted and revalued at the end, and the balance would go to cost of goods sold. The ending amount would be determined by a physical count, the ending amount of the inventory, and it would be the amount that would actually be included on the statement of financial position or the balance sheet. As you will recall from our discussions in the introductory financial accounting course, transportation in is part of the cost of inventory, but transportation out is not. So you would also need to adjust your cost of goods sold for the effect of transportation in, paid to deliver inventory to your premises to get it ready for sale. So all of those things, we would have debits to inventory, ending inventory, purchase discounts, purchase allowances, return purchases, and the cost of goods sold because it's an expense. We would have credits to inventory at the beginning inventory, a credit to purchases, and a credit to transportation in, and that would balance our inventory accounts. Now, among the financial statements which are listed here, the terminology is a little different between IFRS and ASPE. So a statement of financial position is called a balance sheet under ASPE. A statement of comprehensive income is just called an income statement under ASPE. The statement of cash flows shows sources and uses of cash, split up into operating, financing, and investing activities. And then finally, a statement of changes in shareholders' equity is required in IFRS, whereas under ASPE we would just reconcile the retained earnings, since we don't deal with other comprehensive income, and we usually don't have a lot of changes in small and medium-sized businesses. We don't have a lot of changes to the share capital accounts. And so those are the major differences between IFRS and ASPE. Okay, a little bit of a review of debits and credits. Debits are on the left-hand side, credits on the right-hand side of a general ledger account. The double entry bookkeeping system says that each transaction has to have balances. Each individual journal entry is balanced between the debits and credits. Debits and credits don't necessarily mean increases and decreases. They're context dependent, which we'll see in the next slide. Well, actually, it's a couple of slides down. The accounting equation. The accounting equation is essentially the balance sheet. The assets have to be equal to the liabilities and shareholders' equity. And the shareholders' equity is composed of the common shares, which is contributed capital from the shareholders, retained earnings, which is the historically earned income within the company, minus any historical dividends that have been paid out. So it's the total of all of the earnings minus the total of all of the dividends in the past. Then we would adjust that for dividends, so we subtract dividends from retained earnings because they're paid out of the company to the shareholders. We would add revenues and expenses, essentially adding the closing entries, adding the income statement, the effect of the income statement into retained earnings. Assets then can be viewed in a larger equation. Assets is essentially equal to liabilities plus common shares plus retained earnings minus dividends plus revenues minus expenses, and that's basically the basis of a trial balance. The rules of debits and credits. The rules of debits and credits is to increase the balance of any account, you record the amount in the normal balance column. So if it's a liability, it's normally a right-hand side credit column account. If it's an asset, it's normally on the left-hand side. So it's normally a debit balance. To increase the balance, you make the entry on the same side as the normal balance. To decrease the balance, you make the entry on the opposite side. And if the transaction is properly recorded, then the accounting equation will be balanced. The total debits will be equal to the total credits. In addition, we can develop this table to show how that works. Assets are normally a debit balance, so a debit would be used to increase them. Liabilities are normally a credit balance, so a credit entry would be used to increase them, and a debit would decrease liabilities. Shareholders' equity, also normally in a credit position, so they're increased with a credit. Revenues increase retained earnings, so they're essentially the same as shareholders' equity. So revenue is increased by a credit. Expenses are increased with the debit because they reduce shareholders' equity. So we've talked about all of the steps in the accounting cycle. Here they are listed. We start by analyzing the transaction, determining whether we have the basis to recognize the transaction in our books. Then we would journalize the transaction if it was required to be recognized. We would post that transaction to the general ledger and its subledgers. We would prepare an unadjusted trial balance when we're getting ready to do our year-end financial statements. We would prepare adjusting entries to adjust those numbers to recognize accruals and deferrals and any estimates that we need to make. Then we would prepare the adjusted trial balance, and from that we would prepare the financial statements. And then finally, closing journal entries would be made to close all the temporary accounts, revenue, expenses, and dividends to the retained earnings. And then we would often prepare a post-closing trial balance to ensure that all of the temporary accounts had a zero balance and that everything had been closed properly to retained earnings. And then we may prepare reversing entries, and reversing entries are are often used when the person who's preparing the financial statements is not the person who does the day-to-day bookkeeping for the organization. So what they do is essentially undo some of the reversing entries for the accruals and deferrals, so that the entries that are normally made by the bookkeeper don't have to be adjusted for the fact that we did an accounting entry to change the amount of accruals and deferrals. We'll see how that works as we go through the course. So for each individual chapter where there's a reversing entry that could be used, we'll talk about how that works. Essentially, it's for accruals and deferrals. We undo the accruals or deferrals so that the cash entries just get entered as normally they would be entered by the bookkeeper. So the method used to process accounting information doesn't alter the steps in the accounting cycle, whether you're using reversing entries or not. The computerized systems, if computerized systems are used, the accounting records change in appearance, but the steps essentially are the same. The electrons are in there doing the debits and credits. Even if you can't see them, you can print out reports or produce reports to your screen, and you can do reconciliations in the same way as you would with manual accounting system. So in general, we talk about when we are journalizing transactions, we use a general journal format, and in most computerized systems, that individual journal balancing procedure wouldn't be necessary, because we would use a built-in component within the software to fill out the rest of the entry. So general journal entries are quite rare in computerized systems because everything is kind of set up in its own subsystem. But the way to learn about accounting, the way to understand what's happening with the computerized accounting system, is to do manual accounting journal entries. So I highly recommend that you learn how to do journal entries in the manual form, and then using the computer will be just a matter of speeding them up and making them quicker. You know, the old saying that to err is human, but to really screw things up quickly and repeatedly requires a computer. That's essentially the idea here. So let's look at a few sample transactions. These should be fairly familiar from your past course. So here we have a transaction where we've gotten cash from our shareholders. We debit the cash to increase it. We increase the asset, and we record an increase in the common shares, the contributed capital that we've received from the shareholders. So a debit to cash, a credit to common shares. Common shares is usually equity. And so after we make this entry in the general journal, we post it to the general ledger as represented by these T accounts. And then from there, we do that with all the other transactions and all the other accounts. And at the end of the period, we would prepare the trial balance. So we have our cash account here. Let me move forward. We have our cash account, all the T accounts down the left-hand side. They represent the general ledger, and each of them has a corresponding place on the trial balance. All the debits go on the debit side, all the credits on the credit side, and then you add everything up. Now you can see that this is not a this trial balance has not been closed because it includes a number of revenue and expense entries. So the income statement hasn't been closed here. So that's always a good clue. If you have dividends, revenues, and expenses on your trial balance, it hasn't been closed to retained earnings. So that means that when we see retained earnings on a trial balance like this, it is the opening retained earnings balance. Now, in this case, we don't actually have retained earnings anywhere on the list, so it would indicate that this may be the first year of business if there is 0 retained earnings. But normally there would be a retained earnings balance, and it would constitute the opening number. So from the previous example, we can see that the trial balance actually balances because the debits and credits were the same. If we step back here for a second, the debits and credits both add up to $297,000. That doesn't necessarily mean that we are done. So we need to still do some additional checking for some of these potential errors. Excuse me. So we've just determined the mathematical accuracy of the ledger. It doesn't tell us whether there are missing items. So there could be a transaction which was not journalized. That would usually be identified through the adjusting entry process. There could be a correct journal entry which we've recorded in the journal, which we haven't actually posted to the ledger. So it, again, will show up in the adjusting process. A journal entry could have been posted twice if we forgot that we did it, or we didn't mark it properly as posted in the original posting process. So once again, we look at that during the adjusting entry process to determine whether the balance is appropriate given the transactions that we've seen. It could be that we've posted things to the incorrect account, right? We could have posted an accounts receivable entry to accounts payable, and then both of the accounts receivable and accounts payable would be wrong, and we'd have to adjust for that. Or there could be offsetting errors where we increased one account by the same amount as an offsetting. So we could have debited accounts receivable and credited it for 2 different transactions, and they just happen to balance. That wouldn't be identified by the trial balance process. It would still balance. Normally, though, your transactions, offsetting transactions, would not directly balance unless you're very, very unlucky. Okay, so adjusting entries. The idea here is that we're matching the expenses against the revenue which we recognized. So adjusting entries essentially ensure that that process has been followed. Other reasons for adjusting entries would include recording things which are not journalized on a daily basis, so things that happen infrequently, so that your bookkeeper is not doing them as a matter of course. Often that means that they're not cash transactions, so that would include things like the estimates of bad debts and depreciation expense. Some costs just expire with time, so things like prepaid expenses. At the end of the year, we've used up some of the balance. There's no cash transaction at that point to require an adjustment, and so as a result, we wouldn't normally adjust them as a result of the cash transaction. All right, so the periodic expenses, those expenses which expire with time, would generally not have a cash trigger either, so we'd have to make adjusting entries for those. And any items which were previously unrecorded, generally again would be things that wouldn't have a cash trigger for the recording of the original entry. Those kinds of things are the reasons we would need to do adjusting entries, so that includes the list that we talked about before. So adjusting entries would be required each time financial statements are prepared. So if we're talking about preparing quarterly financial statements, for example, we would make adjusting entries, maybe not the whole list, but it's quite common that quarterly financial statements don't include depreciation expense, for example, or bad debts estimates, but they would make adjustments for things like accruals, accounts receivable, and accounts payable. Those sorts of things would generally be done for quarterly financial statements as well. So, of the adjusting journal entries, the common ones are prepaid expenses. So those are things that we paid for up front and then we're using them up over time. We need to recognize that the amount of the prepaid expense asset has been decreased through the use Commonly, insurance expense or rental expense would be prepaid expenses that we pay in advance and then use up the benefit over time. Unearned revenues, the classic example being WestJet tickets. When we buy tickets, we give them our cash, so they have cash, but they haven't done anything yet. So if they don't give us the flight, they have to give us our cash back, so they can fulfill that obligation, fulfill the liability by either giving us the goods or services, or they can pay us our money back. So either way, it's a liability, and the amount of the liability may be reduced through the earning of the revenue. So the revenue would actually be received in cash up front, and then the liability would be reduced as we actually deliver the services or goods. So an example for prepaid expenses is shown here. Prepaid expenses expire with the passage of time. So the company paid $6,000 for 1 year of insurance. Coverage begins October the 1st. At the end of the year, December 31st, we would have used up the insurance coverage for the month of October, November, and December, so 3 months. And so 6,000 divided by 12 would be, would that be 500 per month? So 500 times 3, we would reduce the amount of prepaid insurance because the asset no longer exists, and we would record insurance expense, which reflects the fact that we're matching the cost of insurance coverage against the revenue earned during this period. On the other hand, when we receive payment in advance from customers for services or goods that will be provided in a future accounting period, that's the classic idea of unearned revenue, sometimes called deferred revenue, but generally unearned revenue is the term that we would use. This would include things like rent. If we are the landlord, we would receive money up front, and then we'd deliver the access to whatever they're renting, and we would earn the benefit over time. Magazine subscriptions are commonly paid up front, and then as we deliver the issues of the magazine, the amount of the revenue would be increased and the amount of the future obligation would be reduced. Any other kinds of deposits, deposits on maintenance or repair expenses, those sorts of things would represent unearned revenue, which would be earned by completing the process, right? We would be able to demonstrate collection, and presumably when we've completed the process, we are able to calculate the amount. So we've got all 3 C's taken care of for the revenue recognition. We've got collection assured because we already have the cash. We've got completion because we've done the work, and calculation or measurement has been taken care of because of the agreed amount in the contract. So an example here, a company received $12,000 for 4 months of advertising expenses or advertising services, and so they're going to issue the ads at the end of the period. On December 31st, we've used up 3 quarters, October, November, December. We still have 1 month left of advertising service revenue that has not been earned, so we reduce unearned revenue by debiting it and credit service revenue to recognize the fact we've earned $9,000 of that revenue amount. So accrued revenues would be accounts receivable. We've earned the revenue, but we haven't received the cash, and so that's the classic accounts receivable. Accrued expenses would be accrued or accounts payable and other accrued liabilities. We've incurred the expense, but we haven't paid for it yet, and so we need to recognize that the expense has already been incurred in earning this period's revenue, so we match it through the process of accrual. Now, note that under the accrual basis of accounting, these adjusting entries for accruals and deferrals are a major difference between a cash basis of accounting and accrual basis of accounting. So if you were dealing with a strict cash basis of accounting, you would recognize revenue only when you actually receive the cash, and expenses would be recorded only when cash is paid. And so there could be significant differences between the cash and accrual basis of accounting, because the accrual basis of accounting moves things into the period in which it's properly in which it's proper to record the transaction. So the accrual basis of accounting recognizes revenue when it's earned, independent of when it's received in cash, and expenses are recognized when they're incurred without regard to the time of the receipt or the payment of the cash. So if we're looking at accrued expenses and accrued revenue, accrued expenses would often include interest expense, which would be paid on a periodic basis. So if the year end happens to fall between two interest payment periods, there would be an interest expense which needed to be accrued. So you'd have an accrued interest payable, and you'd have interest expense set up. This would be a case where you might have a reversal entry after you prepare the financial statements. You might take the interest payable that you had set up and reverse it, so that when we actually pay the interest in the future period, we wouldn't need to worry about how much of it was accrued as payable and how much of it was just normally paid as interest expense. Salary expense, commonly, unless the pay period falls exactly on the end of the year, we may often have to accrue salaries and wages. Bad debts expense is an estimate. We would have to accrue that at the end of the year. Interest earned, if we're lending money to someone else, interest earned would be a similar case to interest expense. So here we have an example on January the 1st or January the 5th. A company pays $20,000 for salaries, which include $10,000 of salaries for the period of December. So presumably we gave them some time off at Christmas, and so only half of the entry, half of the salary payment is for this year and half for last year. So the adjustment we would have to do out on December 31st would be to debit salaries expense and credit salaries payable. And then when we paid them on January the 5th, we would debit the salaries payable for $10,000 and record salaries expense for only the $10,000 which was incurred in January. And then, of course, the balancing would be the $20,000 of cash that would be paid. A reversing entry, if we made this entry that is shown, the debit salaries expense and credit salaries payable, if we use reversing entries, then after we close the financial statements and close all of the temporary accounts to retained earnings, then we would start next year with the first entry to undo exactly the opposite, to basically enter an entry to debit salaries payable and credit salaries expense, each for $10,000. And so then when we made the payment of $20,000, we would just make our normal entry of debit salaries expense and credit cash for $20,000, and the salaries expense would be correct. And then at the end of next year, we would adjust the salaries payable for the correct balance. So the salaries payable at the end of the year would have a credit balance of $10,000. The reversing entry would undo that, so that the salaries payable would have a zero balance at the beginning, but we would have a negative temporary balance in salaries expense of $10,000, which reflects the fact that the $20,000 cash payment is only $10,000 for this period's expense, and was $10,000 from the previous period's expense. And so that's kind of how the process of reversing entries work. And this would be a good example of that. Bad debts, we'll talk about a little bit later in the sales and accounts receivable sections of the course. But essentially, bad debts are expenses relating to unpaid accounts. So they're accounts receivable where we don't think we're going to get paid the entire amount. And so that needs to be matched to the period in which we made the revenue, in which we made the sale. So the sale would be offset by bad debts for that account not getting paid. Other investments might require fair value adjustments. So we'll talk about those as we get into these sections in the course as well. For certain categories of investments, there may be an unrealized gain or loss. When we see the term unrealized, that means it hasn't been exchanged for cash. And so recognized means we put it into the accounting books. Realized means that we've received cash or paid cash in settlement of the accounting, in settlement of the account. And so the fair value adjustments can either happen through net income or through other comprehensive income. Of course, we're talking about IFRS here because there's no other comprehensive income in ASPE. And if that's the case, we have a choice, and we need to make a judgment as to whether the gains or losses would be put through the net income portion of the income statement, or whether they would be shown as other comprehensive income. And we'll talk about that when we get to that point in the course. So included in shareholders' equity under IFRS, there may be a number of things. Common shares and retained earnings would be similar to the situation under ASPE. But accumulated other comprehensive income would be part of shareholders' equity on the balance sheet, which represents the other comprehensive income, unrealized gains and losses, which have been accumulated there. And it's basically historically, it is a historical summary of the other comprehensive income in the same way that retained earnings is a historical summary of the income which was earned in the business. Dividends reduce retained earnings because they're paid out of retained earnings. The income statement would show a net income line or a net loss if expenses are greater than the revenues, and that would go to retained earnings, but other comprehensive income would go to the accumulated other comprehensive income account in the shareholders' equity in an IFRS balance sheet. And notice that the IFRS statement of changes in shareholders' equity would account for changes in all three of the components: common shares, retained earnings, and accumulated other comprehensive income. And so it's much broader than the ASPE requirement to just reconcile retained earnings. If we look at different ownership structures, if we have proprietors and partnerships, as we said, the permanent accounts for both contributed capital and earned capital are just considered part of the partner or proprietor's capital, and dividends would be corresponding to the drawings that were taken out of the company. It's not a company, we shouldn't use that term because company refers to corporations, but taken out of the business. So partners and proprietorships would record those the money taken out of the company and put into your personal bank account as drawings, whereas corporations use the term dividends. And common shares, share capital, contributed surplus, retained earnings, and accrued or accumulated other comprehensive income. So the AOCI there is accumulated other comprehensive income. Now the closing process. The closing process consists of closing entries, and after financial statements have been prepared, then all the nominal or temporary accounts, such as revenues and expenses, need to be reduced to zero in preparation for recording the events and transactions of next period. So the closing process requires recording and posting of closing entries. All the temporary accounts are reduced to zero by closing them through an income summary account. The net balance in the income summary account after closing is equal to net income or net loss for the period, and then the net income or net loss for the period is transferred to an equity account by closing the income summary account to the appropriate equity account, which is usually retained earnings. For a corporation, the equity account would be retained earnings. For proprietorships and partnerships, it would be a capital account, so owner's capital or partner's capital. Dividends are closed directly to retained earnings. A lot of companies don't actually maintain a separate dividends account, but it does make it a little tidier to close the dividends at the end of the period to retained earnings. So example of closing entries is shown here. All the expense accounts get credited to reduce them to zero, and the income summary is debited. All the revenue accounts get debited to reduce them to zero, and this total gets credited to the income summary. And then the income summary net amount, and in this case we have a credit to retained earnings and a debit to income summary, which reflects the fact that it's increasing retained earnings. So in this case we actually had a profit. We had net income in excess of expenses, so revenue was in excess of expenses. And then we would the entry for dividends would always be the entry shown as number 4. We would always be reducing retained earnings because dividends never increase retained earnings. They always decrease retained earnings. And then if we're talking about IFRS, the other comprehensive income accounts would be closed to the accumulated other comprehensive income as a separate closing process. So we didn't talk about that one in the introductory financial accounting course, but we essentially have to do that to make sure that all the accumulated other comprehensive income is properly accounted for, and that the other comprehensive income accounts all get closed individually to zero to start again in the next period. So looking at it in terms of T accounts, dividends are entered as debits. We debit dividend and credit either the payable or cash. So if we actually paid them in cash, we would debit the dividend and credit the cash or the accounts payable. And so we have a debit balance in dividends that would be reduced to retained earnings through entry number 4 by crediting the amount of dividends, bringing it back to zero. The first entry to reduce all of the expenses have a debit balance, so we require a credit to decrease it, and it would be a debit to the income summary. Revenue would need debit to bring it down to zero, and the income summary entry then would be a credit. And then when we summarize the two, if the revenues are greater than the expenses, your income summary would have a credit balance. We would debit the income summary to bring it down to zero and put the balancing entry into retained earnings as an increase. So that's how the T accounts would work. We talked about a periodic inventory system briefly. A perpetual inventory system, every time we buy inventory or sell it, we make the entry directly to the inventory account. But in a periodic system, we wouldn't record cost of goods sold or calculate the amount of ending inventory until the end of the period when we actually went out and counted it. And so that's one of the fun things you get to do as an auditor. Up here, close to the Arctic Circle, you get to go out on December 31st and count things. And so often that's outside, and so you need to bring your furry parka. An example of a periodic inventory closing entry would be what's shown here. The Collegiate Apparel Shop apparently has the following balances in its periodic inventory system. The beginning inventory was 30,000, ending inventory is 26, so we sold 4,000 more than we bought. What we bought was 200,000 gross purchases, and the transportation in would increase the amount or the value of the inventory purchases. Purchase returns and purchase discounts would reduce the amount of net purchases, and so the entry which we would need to make to account for all of this would essentially be, well, first of all, this is the calculation. So we start beginning inventory. We add purchases of 200,000. We take off the purchase returns and discounts for $4,000, coming to a net purchases number of 196,000. We add the transportation in, and that gives us cost of goods purchased. We add that to the opening inventory. We had $232,000 of inventory available for sale during the year. We still have 26,000 of it, which means that our cost of goods sold would be $206,000. We need to make an entry for that. So here's the entry. Cost of goods sold, as you can see, is $206,000. Ending inventory is being debited, so we're actually recording that amount as an asset. You'll see at the bottom, the inventory beginning goes away. So it takes away the beginning inventory and brings it down to zero and replaces it with ending inventory of 26,000. The purchases needs to go away. It's a temporary account, so we're reducing it by crediting the $200,000. When we originally recorded the purchases, we would have debited purchases and credited cash or accounts payable. Transportation in, we also reduce that for the same reason as we reduce purchases with the credit. And purchase returns and discounts. Purchases returns would be things that we sent back to our supplier because we didn't want them, and they gave us credit for the fact that we don't owe them that money anymore. And purchase discounts would be discounts we took because the purchases were either inappropriate for what we wanted, and so they gave us a little bit of money off, or they could have been volume discounts because we purchased a substantial amount from that supplier. But it balances, and our cost of goods sold and ending inventory are the results of this journal entry. Moving on then, just to wrap up the last little bit of this chapter, valuation techniques. We use a number of different valuation techniques to measure a number of different financial statement elements, and they kind of fall into the two categories shown here, either market models, which use an external price or other information to determine what the price should be for the transaction we make, or some kind of income model using a present value technique to capture future cash flows and convert them to current amounts. So we see those two techniques used in a number of ways. A significant part of accounting is that measurement process. Many items are measured based on historical costs, but many are also based on fair value. And it's actually an increasing amount of entries which are based on fair value. So there weren't very many that were using fair value back when I was in school, but now you have a number of fair value responsibilities that you need to consider. Determining an item's fair value is relatively straightforward when market prices are available. And so if you can actually use a market model, that's quite helpful. So however, when a market price is not available, accountants must use other valuation models to develop an estimate of the fair value. So some examples of the measurement categorizations would be cost-based measures for historical cost, less perhaps some amortization. Hybrid measures, so those would include things that have some attributes of cost-based valuation and some of current value. And some are purely current value measures. For example, if we're taking the current value of inventory as the net realizable value of selling it. It's a current value measure. I'm looking for a reference to IFRS 13 here. It doesn't look like we actually have one. But IFRS 13 is the related accounting standard that deals with measurement of fair value. So IFRS tells us that in order to measure fair value, we must first of all determine the item being measured, and then we need to determine, that's this slide, we need to determine the item being measured, how the item would be or could be used by market participants, so somebody else could use it for a different purpose. That consideration would be necessary. So is there something else that we could use this asset for? What market would be used to buy or sell the asset? And if the model was being used to measure fair value, which particular model it is. It could be a valuation technique or model. In most cases, a liquid market for the item being measured would be available. And because you bought it, somebody else presumably would want to buy it as well. And this would best represent fair value. One example would be common shares that trade on the TSX. That would provide the best evidence of fair value because it's a liquid market where there's frequent trading between disinterested arm's length transactors. So in other cases, you may need a valuation technique or model which would be used to value the item. So if you don't have a pure market value that you could use, you would essentially be estimating the value using some kind of a model. And there are a number of examples of models included in section 22 of IFRS 13. In section 22, one additional model that can be used is known as the cost model. And the cost model attempts to reflect the amount that would be required to replace the asset's service capacity. The cost model is used to value older non-financial assets, such as fixed assets, where there's no longer a market for those assets, often because it's obsolete. Estimating a fair value using a model introduces a substantial amount of measurement uncertainty. IFRS 13 attempts to offset this by using good quality input information. And so inputs could be classified into 3 categories based on their quality. And so the model that we're using for a market model, let me back up a second here. Inputs would be classified into 3 categories based on the quality of the information. Fair value measures would be could be calculated using several fair value models using different types of inputs. So as we're discussing here on this slide, when you're determining the value of a financial statement element, you need to determine which model you want to use. Is a market model available, or is it an income model based on an estimate of future cash flows and measurement of their present value? And does the resulting measurement actually result in useful information for the users of financial statements? So those are the issues you need to address. Finally, income models are used in the case where there are cash flow projections which are readily determinable. And so we spend a couple of courses talking about that. The management accounting course talks a little bit about projecting budgets of future cash flows. Corporate finance, Business 370, deals with those issues in more detail in sort of chapters 10 and 11 of the existing course at least. So you need to determine what income model you will use, and it depends on whether you're estimating expenses or whether you're estimating revenues, what the related items are, and what information is available for you to use in doing the calculations. Not really a lot of significant differences between IFRS and ASPE. So there's not a lot that we need to talk about in that area, but there are some issues. So financial statements, and it's basically terminology. So financial statements for ASPE don't include other comprehensive income, so they also don't include accumulated other comprehensive income. There's no revaluation surplus in ASPE because they're not allowed to revalue assets, but in IFRS you can actually revalue your fixed assets, for example, and put that into another comprehensive income called revaluation surplus. The main difference in accounting for measurement issues is IFRS has a well-developed framework for measuring fair values. ASPE doesn't. Under IFRS, most of the guidance is in IFRS 13, which gives us that standardized definition and guidance, which we just talked about in the last couple of slides. You might want to look at Appendix 3A and 3B. Appendix 3A refers to a multi-column, 8, 10, 12 column worksheet, which serves as an aid to the accountant in making the adjustments. A lot of accountants, kind of old school accountants, still use a physical worksheet to make the adjustments. The worksheet would give you an orderly format for the accumulation of information necessary for the preparation of financial statements. You could do it as an Excel spreadsheet as well, so it doesn't necessarily have to be a paper copy. Use of the worksheet doesn't replace any financial statements, and it doesn't alter any of the steps in the accounting cycle. It's just a way of codifying or standardizing the process as you're going through the adjusting trial balance and adjusting entry processes. So take a look at that if you're interested. Finally, Appendix 3B talks about present value concepts, and they're related to the idea of income models, because income models project future cash flows and determine what those values are today. And part of actually realizing the value of the future cash flows over time represents the fact that you're earning interest or paying interest on the obligation. So there's a number of areas where that's applied in financial accounting. So you need to know a little bit about those techniques. We'll talk about them as they come up in the course, but you can take a look at Appendix 3B if you like. There are some time value concepts which are widely used when preparing financial statements under both IFRS and ASPE. So it's important to have an understanding how to do these measurement calculations. They can be quite complex, so spend some time doing that. You need to understand how the impact of time value concepts are incorporated into financial statement measurements. There's a number of places where that happens. So when money is borrowed or invested, usually you pay interest, and that interest is different from the normal business of the firm. So you want to make sure that you treat interest income and interest expenses differently from other kinds of transactions. So the appendix of the textbook touches on the different tools that are available for doing those present value calculations, including formulas that you could use, present value tables, how to use calculators and spreadsheets in determining present value amounts. And that's it for Chapter 3.